Thanks to the stock market's climb to record highs, the money is flowing into mutual funds faster than it has been since 2009, according to Morningstar. And for U.S. equity mutual funds, 2013 is shaping up to be the best year since 2000. But some of the year's top performers may not be worth your money going forward. Doug Flynn is co-founder and partner at Flynn Zito Capital Management, which oversees $300 million in assets. He says investors with long-term horizons should focus on non-leveraged funds. Doug, first explain the difference between leveraged and non-leveraged funds and why you prefer one over the other.
Well, leveraged funds are essentially taking like the market this year up 30% and saying, I want to participate 2 times that. That works well in a year that things are going up. But you might also lever something that was horribly negative. Like a couple of years ago, gold mining stocks were all the rage. This year, they're down 51%. So if you levered that, you'd lose a ton of money in a year like that. So you have to be very careful. And they're also trading strategies, and they're not really long-term investment strategies for most people, certainly not in their 401ks. So
what are the top performing non-mutual funds that you see going into 2014?
Well, so if you take a look at the top performing funds, the ones that the number one performing fund last year that was not levered is a fund that is in alternative energy, and it's up over 90% last year. There it is. And if you look back at the history of that fund for the previous years, it underperformed and was horribly negative year after year after year for the last 4 or 5 years. And so it finally hits it right in a year like this year, and you have to say, well, is that the kind of fund that I want to have? Too many people focus in on what the fund did this year. If performance like that, there's only $8 million in that fund, so almost nobody got that return. But likely people will see it and now begin to put money into it, and that's not the kind of thing that you want to do with a fund like that.
Some of the other ones, the Lord Abbett Micro Cap Growth, the Franklin Biotechnology Discovery. Tell us about those. What are those about?
Yeah, so the microcap fund, first you take small company stocks, which everyone knows they should have some large companies, some small company, and then you further parse it down into microcap. They're the smallest of the small. That's a good spot to be in. They're very aggressive. Every single fund on this list that performed this well, you have to know is a very aggressive fund. And so when you look at that, biotech funds as well, biotech was the number one performing asset class this year. So when you're looking at these funds and their performance, you have to say, well, a lot of that is attributable to the fact that that was a good space. I made a good bet. You have to be very careful. You have to look at years like 2008 and see how these funds performed in a year like that and say, could I stomach that again were it to happen? We don't suspect that will happen, but you have to know that that's part of the reason why these funds have the supercharged performance that they do have.
Are there any particular funds that did really well in 2013 that you advise people stay away from them in the new year, and why?
Well, it's biotechnology, right? So if you have an overall diversified portfolio, S&P 500 style stocks, healthcare is a good healthy portion of those stocks of that portfolio anyway. Then some people like to sector out and say, let me get some technology or let me get some additional healthcare. And then you're further diving down into part of healthcare into biotech. So that's what people are looking at right now, and you have to be very careful. If you would have followed what did very well a few years ago when the gold miners did well, fast forward a few years later, and now you're suffering. And so you have to be very careful. Biotech still looks very good, but you have to be careful. It's always like, don't follow the number one performing fund last year. That's investing only looking in the rearview mirror. You want to take a look and say, what is something I can stick with through the good times and bad, and I want to stick with for a couple of years.
And if there's one piece of advice in 20 seconds we have left, what would it be for investors out there?
You know, real quickly what happens is everyone says, well, I was up 30% last year. How did you do? And they never ask the second question, which is, well, how much risk did you take to get that? And if you had a fund that took half the risk of the market and got a 20% return, you know, if the market was up 30%, your expectation is only 15 because that's half the risk, half the return. But if you got 20, you did better than you should have. And that's what you really need to focus in on a little bit, is look at the manager and look at the risk-adjusted returns.
Doug Flynn, co-founder of Flynn Zito Capital Management. Doug, thank you so much. We appreciate it. I'm David Shuster in for Velshi. Thanks for joining us.